Hello, everyone. I am just thrilled and excited to have you with us today. I am really, truly excited. We've got such a great panel. I'll be introducing our moderator in a minute. She's extraordinary. But let me just take a minute to welcome all of the participants. We're recording this and it'll be widely available, but those of you who are here get the privilege of being able to ask this illustrious, impressive panel some real questions, and we're excited about that. We are thrilled to have a lot of great people here today, and in the audience as well as on the panel. So this is going to be a great discussion. I appreciate you all being here. Let me tell you a little bit about the Crowdfunding Professional Association. We are a national association of people who participate in the crowdfunding world. And that includes, of course, the portals and intermediaries, the broker dealers that participate in crowdfunding under regulation crowdfunding, regulation A+, and some local state exemptions, et cetera, et cetera. It also includes the professionals who surround this community, the attorneys and the experts and consultants who help people with their crowdfunding be more successful. And of course, and most importantly, it includes the issuers, the entrepreneurs, and the businesses who use crowdfunding to raise money, and the investors who invest in them. Without investors, crowdfunding doesn't work. So this is an important ecosystem. We're right in the middle of it, and we're proud of our role in helping to foster and grow this important part of the national economy. We host this monthly webinar each month on the second Wednesday at this time, whatever time it is if you're live right now. So typically it's at 2 p.m. Eastern time, 11 a.m. Pacific that we begin. And we're here every month. We will, next month, we will be hosting a session on local investing, and we're excited about that. We've got a great panel of experts who are all super knowledgeable about local investing, and you can register for that event. It's free. And you can register to participate and be in the room and have the opportunity to ask questions of the experts at the link below. We also are co-hosting with the Super Crowd Inc. I admit that's my little business, and a webinar next week. This is not a free event, but CFPA has a few free tickets. So if you would like a free ticket, I'm going to share a link now where you can register for the webinar next week with the Super Crowd Inc., where we'll be learning. This is going to be an impact investing 101. That is how to start impact investing with just $100. And King's Crowd's Leah is going to do that training. It's going to be great. Now, let me just take a minute to thank our sponsor. Our sponsor couldn't be here today to represent themselves, so they've asked me to deliver a little bit of a message. But our sponsor is CrowdCheck. CrowdCheck is a great organization that provides support, especially legal support around crowdfund offerings. And so CrowdCheck Law is a law firm that provides support for a wide range of legal compliance and diligence documentations services for all types of online capital formation. It's a great organization. Let me just share a link. It's not hard, of course. Crowdcheck.com is the link, but I encourage you to check it out. We are so grateful that CrowdCheck sponsored the event today, really making this possible. We could not do this event without the financial support of a sponsor. with that, it is now my privilege and opportunity to introduce our extraordinary panel. Beginning, I'll introduce the moderator, Jenny Kassan, and Jenny will introduce the panelists. So sit tight, and we will anyway. Introduce Jenny. Jenny is an extraordinary human being. I've known Jenny for over a decade. She's one of the leaders who helped us create crowdfunding. She was doing crowdfunding before crowdfunding was cool, under a variety of state and federal exemptions like 504, Reg D 504, and doing all kinds of little creative things to allow but she was one of the key voices behind creating what is the Jobs Act and what is now regulated crowdfunding. We're excited to have her as our moderator today. So Jenny, I'll turn the time over to you so you can introduce the panel.
All right. Well, thank you so much, Devin. This is so exciting. I feel like this is almost a culmination of what I've been trying to see for so long in terms of getting more and more people to get excited about investing in the things that they're passionate about outside of Wall Street. I will actually I'm going to ask some questions of the panelists, and within that, let them introduce themselves a little bit. But I was trying to look back through my email to remember when I started making crowdfunding investments, and I actually, made some investments before the new law went into effect in 2016 via the old style of crowdfunding under state registrations. But one thing we did, I actually co-founded a crowdfunding platform called crowdfundmainstreet.com. And we had this big launch event, and we had 5 companies launch, all women-owned companies. And we had this big party in Oakland. And that night I got drunk and invested in all 5 of them. And then I found out later I wasn't supposed to do that because I was a co-owner of that platform. So anyway, these 5 companies, most of them are still around doing amazing. So yeah, it was a great feeling to be able to invest in these awesome businesses. So what I want to do is go around the room and ask each of you panelists to share a little bit of your background and how you got into investing in crowdfunding deals. So Niki, let's start with you.
Okay, well, I have been an investor and trader for, I don't know, maybe 25 years. And so I have a long history of investing in commodities, penny stocks, basically, everything in the market. I have books on the market. I do candlestick, looking at those sorts of things. So I've done a lot of really studying of the market, the stock market. And then in 2011, I started investing as an angel investor in probably about 5 different companies. So that was my first time in sort of the private world. And so when I first saw in 2017 about how to invest in crowdfunding stocks. And so that was really exciting to me because then I could invest in so many more companies. The access was terrific, as opposed to knowing people that have a startup and coming in as an angel investor. So all of a sudden there was this whole world open to me. And it was very exciting. And I have since invested in about 230 crowdfunding companies. So that's my experience with crowdfunding. I'm actually writing a book also about investing in crowdfunding companies. The books that exist out there right now are really geared for the companies on how to pull in the money, but there's really nothing that I can see on YouTube or Amazon that's really geared towards the nuances, the small little things you won't find out anywhere else, and how to deal with it day to day. So that's sort of my the culmination of my experience in crowdfunding.
And do you want to just share, how many investments you've made? What's the average amount? So we get a sense.
Yeah, I started off, so I have over 230. And I started off, well, I wouldn't say really small, but I don't ever do anything under, say, $300. But I typically will start off on the smaller side. And then as a company grows and their valuation goes up, then I dump more money into them. So that's sort of been my pattern. So some companies I have as much as $10,000 in, other ones as little as 300. It's just, it varies all over the place.
Oh, that's awesome. Okay, we're going to get a lot more into how you got there, but first let's go around and introduce folks. So Andrew, tell us about your background and how you got into this.
Sure. Thank you, Jenny. I'm thrilled to be here. So I'm Andrew Savikas. I'm the publisher at yieldtalk.com, which is a website with a lot of resources for investors who are interested in this ecosystem. And the website really came out through my own journey. My first investment was through Funders Club in a startup. It was an electric skateboard startup, actually. I was working in and around the tech industry and felt like I had enough knowledge to start evaluating startups and was excited that there were ways to get in at smaller amounts. And then as I learned what else was out there, discovered that there were not just startups that you could invest in, but there was real estate and there was artwork and there was wine, there's all these different asset classes. And I struggled to find good resources on maybe could find a real estate blog here or a startup blog there, but I couldn't really find things that covered the full the full spectrum of assets out there. And so started doing research on myself. And there were kind of two dimensions here. One is all the different kinds of things you can invest in. Again, litigation finance, natural gas drilling, music royalties, franchises. I mean, so many different things, farmland. But then there's also the details about who can invest and how much can you, Regulation D versus Regulation A versus Regulation CF, and all these different, this sort of alphabet soup of terminology. And so really the website came out of my own way to document what I learned along the way. And over time, I've, again, done investments in startups. I've done a fair amount of real estate, done litigation finance, done Bitcoin mining, done quite a bit of different, and of course, startups through both Reg D and Reg CF. And most recently, I've been really getting involved at the lower end of the amounts, supporting a company I'm advising called Dorio. And they have a venture club concept where they will pool investors for as little as $10, pool those into Reg CF offerings. And so I'm excited about it because it's a way to get people who are early in their investing career who aren't able to write 4, 5, 6-figure checks involved in learning about what the process looks like and how to evaluate companies so that they can be much more capable as they develop further in the investing career. So that's where I come to the table from, and I really have invested in and care about not just companies and not just real estate and not just this, but really the full ecosystem of what's now available out there for alternative investors.
Cool. And how many crowdfunding investments would you say you've made?
I would say, especially when you factor in some of those ones that I've done through Dorio, we're definitely into maybe 30 or 40 at this point. And again, it's been anywhere from as little as $10 up to $10,000, depending on the opportunity. So really kind of all over the place. And one thing I learned early on is I was getting a bit of paralysis by analysis, deciding whether to do something like I'd never invested in real estate before. What do I do? I ultimately came up with, look, let's pick an amount that I'm comfortable spending, not because I think I'm going to get a huge return, but because I'm going to learn something. And I really thought about that first investment in a new asset class as essentially, it's like paying for a course and learning how to invest. It was all the things I was going to get out of it, less so on the return and more about the experience. So that was a breakthrough for me in saying, some of these things you have to be able to start small and with the amount you're comfortable putting at risk, but also treating it as much as a learning opportunity as a true investment.
Mm-hmm. Got it. Okay, cool. Derrik, tell us a little bit about you, how you got into investing in crowdfunding deals and kind of where you're at with that now.
Sure. Well, I'm a cybersecurity engineer. That's normally my background. I was doing a wide range of consulting gigs, and what I said, I ended up having a lot of extra money. Now, I had two things. One, I was like debating, well, do I start a company? Do I want to do what do I want to do? And I said, you know what? One of the best ways to ever learn about a company is to invest in it. And at the exact same time, I was helping out with like the campaign stuff and the Jobs Act pass. And I was like, let me find out something. So I put in a couple $100 just to see it. And, I did that when I was like, hey, what's $100, risk, I'll throw it out there. And then I started to, and I got a chance to see, I'm like, okay, so you get a chance to understand the market analysis, you get a chance to understand the pitfalls, the roadblocks, all the different things that a company would go in an industry. I was like, you know what, I might want to expand this out and sort of see where it was going. Now, I am a big narrative person, so that's actually one of the things for me when how I invest along narratives. I'm a big sustainability, IT, AI, that kind of thing. These are my worlds. So renewable energy. So I definitely try to keep, I don't stick within that vein, but those are the ones I lean heavier on. And I like Nikki, I'm in about 300 or 400 companies. But what I did was I do start off a little smaller sometimes, because some of these I'm willing to take a flyer on. I'm like, you know what? It fits my narrative. I'll put it in. Let me find out. Because like I said, it's like Andrew said, it's like getting a class. It's like $100 for a lesson in renewable or recycling, using or getting rid of oil using mushrooms. Oh, this is great. I'd love to learn about how they're doing that. So, and that's exactly how I went about it. And then after a while, like Nikki said, you watch the company's traction. You know, you see how well how well they grow. You know, because I think in most cases during the normal initial analysis, you can see, is there a market need? Is there something for this company? Yeah, you can establish that. But how well does that team deliver? How well do they know how to pivot? That seems to be the biggest thing. And knowing how to handle pitfalls is a great lesson. So as they prove that they know how to do that, I may invest more. And you get more and more invested in the company. And I would also add that, you know, what my goal is now to get to a point where, I mean, ideally is to quit doing the cybersecurity, you know, and just, because I took 2 years off. So I used to be accredited. Now I'm not as much. So I see a different side of things. But as I get more and more into it, I want to get to the point where I'm a value add investor, where I'm able to do some of my skill set and help out a couple companies. Now, there's a couple that I do get a chance to do that in, which is extremely rewarding. But you know, you want to build on that and hopefully get to a point where that could be a main, even if it's just for shares, you know. And I have my passive stream set up. You know, I haven't gotten to litigation stuff. That sounds interesting, Andrew. That's something new for me. I hadn't even thought about that. So yeah, that's more my world. So that's how I got in.
Very cool. Gosh, so many things I want to talk about. But I think a good place to go next. Oh, and I do want to say, for those in the audience, if you have questions, I want to be sure we get your questions answered. So feel free to go to that Q&A section and type your questions in the Q&A interface, and I will I'll bring up the questions as they come in. So what I was thinking would be interesting to talk about is two of you mentioned how there's really not a lot out there to support people who want to start making these kinds of investments. So, and I'm actually working really hard as part of a movement of people that are trying to build this ecosystem. As Devin always talks about, he's like, okay, the number of people that do crowdfunding is like less than the number of people who ski or something like that. And so it's like still a very small percentage of the population that's really doing it at all, you know, not 200 investments, just even one. So what would be your suggestions on things that could happen that, you know, whatever player you're talking about, whether it's the SEC, whether it's lawyers, whether it's platforms, nonprofits, like what do you see as things that those kinds of players could do that could grow this ecosystem and get more investors comfortable and excited to do this kind of investing? Niki.
So if I understand your question correctly, it's about how to bring in, how to market it, how to expose more people to the potential.
Right. Just, I mean, there's so many people who have heard about it, but they've never dipped a toe in. Like, what do you think it is that holds people back? And what could we do to get more people to go ahead and take that dive to make that first investment?
Well, that's an interesting question. I'll tell you a little story on the side. So I have a son who's in his 20s and trying to decide what he wants to do to major in and wants to go back to college. So I told him, I said, I want you to look at WeFunder and Start Engine, and I want you to look at all the zillions of companies out there. Look at the ones that excite you to see what kind of major you want to be in, and look at the C-suite in the company, and what did those people, what is their background, where did they start, so that you can see, what's a really good pathway for you in college to get to that point. So that's just one small thing that we could do, is basically talk to our family members and friends and say, well, just look at the websites, because the websites are very sexy. So, and the platforms are very sexy, the way they're laid out with all the different companies. I think that when people look at it, they are really, it really opens their eyes into, wow, this is a whole new, interesting, fun world. And so that's, I guess, where I would start, is just personally letting people know that there is this thing called equity crowdfunding. It's simple to get into. It doesn't take much money, and show them the platforms.
What would you say, Andrew, would be helpful to get more people into it?
Yeah, that's a great question. I think it would help to try to normalize the idea that most people should have some of their investment portfolio in alternative assets. I'm not sure the right way to get there, but I think there's something about making it not seem so exotic and strange. And part of that is probably something like, there's lots of things that it used to be only sort of really rich people could do, and now everyone can do them. And I think this is the same thing. I mean, it used to be that only if you had a family office or you were an endowment could you have your portfolio allocated into real estate and into private equity, into these sorts of things. And now it's just so easy for anyone to do it for a really small amount that, I think it would be great to figure out some way to help make it so that people ask their financial advisor, or when they're reviewing their own portfolio, say, well, I should probably have 5% or 10% in things that aren't the stock market. And how can I do that? And where should I go to do that? So, that to me seems like a thing that would make a big difference, is if we got more people thinking about and talking about, do I have whatever it is, 5%, at least 5% in non-traditional asset classes? Well, I don't. Well, how should I need to do that? And then people start looking for it and start asking questions and start down this path that hopefully leads you into, making your first investment.
I love that. I think that would be really helpful, because I think right now people think of it, well, maybe I'll do it, maybe I won't. But if they have their mindset that like, oh, I need to allocate 5% of my portfolio to this, they'll take a more active approach to finding stuff. So, Derrik, what about you? What would you think would be helpful?
So I have a lot to speak on. I'm gonna scale it back, but I do a lot of risk compliance stuff. So I look at it from the other side. So sometimes, what are my risk of investing? What I'm risking here? And I think, as with all new industries, people are reticent to jump in until they see success, and they want to see somebody, we need a big winner. We're early. That doesn't really happen as much, but they want to see some people, regular people that have done it, succeed. So that's a big part of it. Now, also, I think also you take a person like me that does a lot of narrative investing. If I want to work in certain industries, I have to also, now I'm at the point with all the companies I'm in, I have to have secondary considerations like, well, can I invest in them? Can I work in them now if I'm invested in them? And I'm wondering how that's going to play out. I'm just now getting to the point where I'm worried about, okay, well, now that I've taken the chance of investing, how I can't divest myself of this, what do I do? So, and I think some of the retirement vehicles, there's a lot of mechanisms that, and I know the big bad brother, everybody hates government, but I come from a world supporting government, but there could be mechanisms and plans where, as long as you're dumping it into a retirement plan of some sort, because now there are vehicles that I didn't know it when I first started that were available, where you can do crowdfunding through a retirement vehicle. And then you could actually be blind to it, like a blind truth, some kind of mechanism. Then you're fine to invest in whatever, and you don't have those risks of other stuff. Something like that, I think, would go a good long way to help ease that side, because there's a lot of people that I know in the tech world that just have cash and they blow it on dumb stuff. They would do it. They would spend it on something like this. So And then the other thing about, learning, people are trying to retrain and learn, and understanding somehow the best way to get into some of the new, like, people are looking to make a pivot in their jobs. They're like, you know what used to come, they used to give retirement plans, they used to have pensions, they don't have any of that anymore. What am I going to do once I'm 43, I may not look it, but I'm 43. And you get to the point like, nah, there's no plan for me, buddy. I need to find another way. And I think helping bridge that, maybe even through plans through the companies, as a way to help. I used to sell life and health insurance back in the day as well too. So, I understand talking directly to these companies, they could help funnel people towards a crowdfunding thing. It's just exposure is a big part of the equation, and seeing success stories, and then those first steps not make it feel like you're about to run into a roadblock. I know from also people concerned about the tax side of this, that's how do I go about? And as with almost everything, the real blame, it seems like the people that really get ahead, there's one key thing they did is they prepared beforehand to make that next leap. So knowing that right step, and because I'm looking back at even my first, I'm like, oh man, I wish I'd known. I should have done it this way. And just from a financial standpoint, I could have, saved myself. Those little things, those pitfalls, and you help people avoid them, it'll go a long way.
Yeah. Yeah, there's definitely a lot of education. I feel like sometimes people don't even really know what they're investing in when they invest
Sure.
in a crowdfunding campaign.
Sure.
I know that that's true. So yeah, that would help.
And now the scammers are coming out. They're here.
And I wouldn't even say it's the scammers. It's more just like a lack of clarity of like, what am I actually getting? Am I getting stock? Am I getting an interest in this special purpose vehicle? Am I getting a safe? What the heck is it that I'm getting? And people sometimes don't even look at that. And it's not necessarily the fault of the platform. They're just like, yeah, I'll invest. And they don't really know what they're getting. They don't know what the tax implications are. So
Sure.
but I would love, and again, like, I feel like we could talk about this for several hours, but I'm going to try to go to the most important question. So I think the next question I really want to go to is how do you decide? There are so many opportunities available. Like, what motivates you? I know when I made those 5 investments in those women entrepreneurs, it was, I honestly was not motivated by financial returns at all. I hoped maybe I would get a financial return, but I just happened to love these 5 women. I love their businesses. It just felt really exciting to me to support them. So, and then of course, one thing you've already mentioned is the value of the education you get. So there's many, many different motivations that go into that decision to invest in one thing as opposed to another. So I'd love to hear more about what motivates you to choose an investment. Because I think that's super helpful for people who are doing campaigns to hear, what makes an investment, what makes an opportunity really attractive. So Niki.
Yeah, well, for me, I'm less interested in the industry in terms of social good or something like that. For me, I am truly looking at it only through the lens of, am I likely to make money on this investment? So I might be the outlier in this, where right now the trend is to, oh, I love this industry, I want to invest in it. For me, it's strictly, this is my retirement plan, essentially, because investing in crowdfunding companies is not a get rich quick scheme. It is a long-term thing. And so I think that people ought to take it very seriously in that way. Now, of course, it's great when some company comes along and you love their vision, and I'm not going to downplay that, but I don't think it should cloud people's goals and get distracted by the vision. So for me, I think that I will say that I think crowdfunding has been the best thing that's ever come along for companies. But I think that investors need to take it very seriously and understand what they don't know, and really try and do some due diligence. It's great for the companies investing because their due diligence goes out the window. They don't have, VCs, pouring through their data room and looking at everything, right? And so what you are exposed to on the platform is really, it's what they make it sexy. They want it to be enticing, right? But your question really is, well, what don't I know? And so I think it's important. I mean, to me, most people, I read the questions. Some of the platforms, people can post questions, right? And I read the types of questions, and I realize that 98% of investors are really not savvy. And so I think that, picking up a book on investments is really, one good place to start to help create your plan, so to speak. To me, when I look at the questions, I see that the summary of most people's investment experiences, their companies manage their 401ks and high flying stocks. They typically invest in some crypto, and their only real exposure to investment is on Robinhood. So they really don't have a lot of experience. And so I think that they need to go the extra mile in trying to actually create a plan for them of how much they're going to give, maybe how much they're going to give to different industries, 10% to the EV industry, 5% to food, what have you. But I think that they need to start with a plan rather than just the allure of the sexy platform and the sexy companies. And because it's very exciting when you look at what these companies are doing, but you have to realize that these companies have a history before they went onto the platform that you don't know about, and you don't have access to them in the way that a VC would have to be doing due diligence. So I do think that to me, what you invest in, like for me, for an example, I have learned the hard way that some industries are just ones that maybe take a lot more time to make money out of. For example, the biopharmaceutical, they have so many things they typically have to do with the FDA, for example. And so you realize, wow, there's going to be a lot of hoops they have to go through before, anything substantial happens with their company. Or for me, my personal experience is that food and clothing, those are industries that traditionally have a harder time making it. I mean, how many restaurants around town shut down, right? How many clothing companies, things come from China now, so it's very hard for those companies to make revenue when they've got to price their shorts at, $90. So you have to, look at the experience. I mean, the realm that company is in. And of course it helps if you have experience. So if you're somebody who's in the clothing business, you understand that segment, and you'd have a easier time understanding what that company's doing and how they're going to make money and what their outlook might look like for you to make money in them, right? But if it's an industry that you're not familiar with, then I think you really have to spend the extra time to really decide that it's a good investment.
Yeah.
Yeah.
Andrew, what about you? What motivates you when choosing what to invest in?
Yeah, there's, I would say, like three main criteria. I mean, first and foremost is, as Niki said, there's the financial return piece of it. So sometimes it's just about saying, well, I want to invest in this because I think it's part of diversifying my portfolio, and I expect a particular kind of return that is, in line with what I want for my overall investment goals. There's a second piece, though, is sometimes it's about investing in the kind of companies and products I want to see more of in the world. And so it's, in some way sort of voting with investment dollars to support a particular kind of company, particular kind of business, or in some cases, a particular category of entrepreneurs and companies that maybe aren't likely to get funding from other kind of places. And so I think one of the great things about this ecosystem is it is providing another avenue for capital that's makes it possible for businesses that might not be able to get it in other ways. I think that's great. And then kind of the third category is the opportunity to get better at analyzing, sort of the meta thing of getting better at analyzing companies and businesses and investments. And part of that is, throughout a business career, you're going to have opportunities to work with and partner with and do business with lots of different kinds of companies and industries. And the process of reviewing investments and even making investments teaches you a lot about those companies and those industries, and that can help you along the way in terms of being better at assessing a potential acquisition target for your company, or really understanding the career background of someone you want to hire who may have gone through a startup or an industry like that. So those are the, broadly speaking, those are the reasons that I have used when making investment decisions.
Cool. And I just want to remind folks, if you have questions, go ahead and put them in the Q&A section. Hopefully you all can see that at the bottom of your screen. Derrik, what about you? What do you look for when choosing investments?
So to echo parts of it, so first and foremost, I'm invested in everything. Like crowdfunding is it's only less than 20% of what I invest in. I'm in literally everything except for litigation. That was something Andrew brought up. But I definitely in this to make money, right? So let's not get it confused. I have a tendency to pick and choose my offerings from a wide variety. I go from seed to Red J because I want to see. Each one has different implications, how long you need to be in, or expectations of how long you need to be in. Different states of how far along the company is as well. So and also they, the risk reward ratio is a little different on those as well. So I look at a lot. I make sure to go across the board on that front. As far as what I select company wise, I do still, I mentioned earlier, I'm a narrative guy. So I'm sustainability. I'm into renewable energy. I do like those industries because I think they're important. So, I need companies in these industries to grow. I personally feel that this is important. So that's a big part of it. But, I actually also am a big believer that the small business is dying. So, one way to help it out is help provide capital for them. So, so these little things is how kind of along the ways and I'm looking for these companies. I won't know all the founders, how they go about their thing. I do look for a couple things. I look for some of them: industry experience, their network in the industry as well. Because there's a guy, and take an example, farming, and you say, okay, there's a million different types of farm, but there's a guy that understands the new tax laws, understands the new bills that came along. So the non-dilutive equity that's available out there, or non-dilutive capital that's available for them, is huge. And understanding that beforehand, before you invest, is important, because you can see, oh, you're like, all right, he'll be able to take advantage of this. He already knows the people in this industry. He has connections already, this, and this. And you can go, all right. And then you say, well, what are they offering? Is it something new? Is it something that's a game? I'm a disruptor. I love innovation. I'm an inventor myself. I love disrupting things. That's my obsession. So, and is the product they're offering disruptive? I look for those things. I do have a tendency to sway away from a couple industries. Food, I have a tendency to sway away because I love food and I can't think objectively towards it. So that was one thing I said, hey, there's no way I could be honest broker on this. Let me stay away from it, and also I'm reticent for anything that is super heavy capital intensive, like sometimes hardware. I have a tendency to be avoided, just like, ooh, as a startup, especially early seed, I'm a little hesitant unless it's just super disruptive, super okay, but I still stay away. So those are the long lines of what I do.
All right. So there is a question in the chat. I don't know why people aren't using the Q&A thing. Maybe they don't have access to it, but there's a question about choosing a portal. And I think this is a really important question. I'm a securities lawyer. I didn't mention that before. And I'm very fascinated by kind of the interesting amount of compliance or lack thereof that happens in this industry. It's, it is a bit of a Wild West. There's some things that happen on the platforms that all the lawyers I know say, wow, I can't believe this is happening. This is clearly not legal. And yet it happens and nothing seems to come of it. There have been some fines in the industry for some egregious behavior. But there's some variability also I've noticed in terms of things like For example, there's this thing called the Form C. The Form C is the thing that is required by the SEC to be filed that has all these disclosures in it. And some platforms, it's very hard to even find the Form C. And I would guess that a lot of people invest without even maybe being aware that there is such a thing as a Form C. So to kind of go to that question that was asked in the chat, given there's so many different variables when it comes to the platforms, but like given the different levels of effort to really be very transparent, the past in terms of past non-compliance that has resulted in fines, the general user interface, the quality of the deals, like, do you have any preferences of some platforms over others? So let's start with Niki.
I think that what you just said is true. That, see, to me, equity crowdfunding is still in its infancy, and the platforms have been changing as well. I mean, there's updates, and actually I give them feedback as well. Like, oh, I can't find this. Why did you take it off? You know, so I'm constantly providing feedback to the platforms. And I would say that the larger platforms such as Start Engine and WeFunder are, because they're larger, I suppose that they are better at sort of putting the information there that you need and being able to find it. There's other platforms that are smaller that I also have, investments in, but they don't have a Q&A section, or they don't have a this section or that. And so I tend to lean more towards the more established platforms that that have good customer service, where I can also email them and say, hey, what do I do about this or that? Where do I find this? So for me, choosing the platform is important, and also recognizing that, things are moving very fast, but it's still, this whole industry is still in its infancy. So was there a second part to your question that I didn't get to?
No, just, how you choose the platform, because someone in the chat asked, any concerns or suggestions when maybe from the issuer's perspective.
So also I would say there's a reason why there you can find on Google all the time, like the 10 biggest platforms, and there's a reason why those top 3, 4, 5 are on that list, and that is because they tend to have better updates. The companies tend to be to update you more often, and it's just easier to deal with in that respect. So I feel like there's more visibility into what's going on with the companies on some of those larger platforms. And for me, that's kind of important, because I have, with all the investments that I have, I get a lot of emails. I mean, every day, I don't know, probably 50 emails, maybe 100, I don't know, I get a lot of them, right? But some of the platforms that are smaller, I don't get those updates, and that's a little disturbing to me. Like, well, whatever happened to that company? What are they doing? and also, companies do switch platforms, and so that can be, now you have to try and find their old information on the other platform, and that stuff can disappear. So so that's something to keep in mind too, is when you have investments, the same company can be on 3 platforms, and a lot of times they move on to private, where then the good thing about the private is you're not paying the fees, like you pay the 3.5% or whatever to WeFunder, but the companies typically have no fee when you invest directly through them. So now you not only have the platforms, you have to look at the investment through those companies, and then you get even fewer updates. So I would say that unless you see an investment that's really, really captures your attention on one of the smaller platforms, it depends on how many investments you also plan to have. If you're going to have 5 investments, sure, you can invest on 5 different platforms, and you could follow and keep up on what's going on with your investments. But if you plan to have a lot of investments, you want to try and simplify things and make sure the communication is good between the platform and yourself, that you can get in contact with them, that they have people promptly responding. because sometimes you do need to really get in touch with them fairly urgently. And so you do need that good customer service relationship. And some of the platforms are not so good at that. So I do place value on that.
Yeah, and I will definitely move on to Andrew in a second. And I just want to say that it is super interesting to me that the platforms do get so involved in the post-raise activities in terms of reporting and even processing payments, issuing tax forms. Because when the law was first passed and the regs went into effect, there was absolutely nothing about that. There was no contemplation that the platforms would be involved at all after the raise. I always assumed it would just be on the issuers to do it. So that is a value add that a lot of the bigger platforms have chosen to do, but it's totally not their responsibility. And I kind of wouldn't blame them if they didn't do it, because it does create a lot of extra kind of work and expense and potentially even liability if they do it wrong. So anyway, Andrew, go ahead.
Yeah, I just want to add that, one of the things that I try to tell people from an investor perspective, one of the most important considerations when looking at the platform is I put them into two different broad categories. One is platforms that are very curatorial and selective in what they put on there. And there are some that they tout the fact that only 1 or 2 or 3% of all possible investments, whether it's real estate or startups, ever get to their platform, right? And then another category is ones that are on the other end of the spectrum, is more of a marketplace model, where essentially anything that meets the minimum requirements is going to go up there. And I don't necessarily have an opinion one way or the other. And sometimes people are comfortable making those evaluations. They just want to see as much deal flow as they can. Other times people aren't necessarily the most confident in evaluating these things, and they want someone else to be doing that curation for them. But I think it's important for investors to realize which one of those they're looking at, because it's a very, I think you have if you know essentially that any company that meets the minimum criteria is going to get on this platform, that's a different lens you're going to look at those opportunities versus ones where you feel like there is a real set criteria for diligence and requirements, and things have met certain hurdles before they even appear. That's going to make you think differently about them too. So that's an important distinction that I think that investors should really keep in mind when they're looking at platforms and considering which ones to invest with.
Yeah, that's a great point. Derrik, what about you? How do you decide which platforms, or do you just kind of look at all of them and find the deals that you like the best?
So I am a broad guy. I do go across quite a few different platforms. Now, each one has provided different things. Yeah, to be honest, being so early, I even question some of the diligence that even the main players have. To be honest with you, they're the big dogs in the field, but I still question how they go do their diligence. I do think their communication levels are important. I also, admittedly, I do look for the bonus shares. So the sites that offer the bonus shares, let's be honest, I do look for that. And then I also like industry ones. So like Space Ventures. The reason I may look at something like Space Ventures is sometimes what happens is if you have a lot of really active investors, they do have a tendency to get involved. And they share people and companies and put people in contact with this person and that person. And that's how some of these companies take off. So you want to see a platform that is like cultivating a certain level of growth as well. And I've seen that happen quite a few times. And it's actually really great to watch that actually happen. And it'd be like the founder will say, from one of our investors who put us in contact with this person, and now we have a contract. That's an amazing, I think that's kind of where I'm trying to be, for a lot of it. But so I think that's important. I have also seen some pretty good deals on some interesting sites off on the side, and I think a lot of these companies are raising on the main ones, the initial one, and then later they step off and do the whole, let me do some of these private ones then, once they feel they have enough name or recognition out there, because they have enough, even within their already existing investor pool, enough money to pull. So I try to make sure to look everywhere. I found some great ones on Net Capital, which was a smaller at the time, was something smaller, I wasn't even planning to look for. And my favorite was Seed Invest for a while, but they got bought up. So, hey, but, so I'm hoping they bring in all those practices that Seed Invest have. I haven't seen them happen, but, hey, whatever. But Yeah. So I don't know. Yeah, I guess Nikki had something to chime in on that.
Yeah, so I think it also depends on what kind of investment you want to do. If you want to do a safe or equity kind of thing, because for example, if you really like safes, you'd want to go to WeFunder. If you're looking to buy stock, you'd want to go to Start Engine or one of the other companies, right? Because WeFunder, they love to do safes. But I will say too that over time, the quality of the companies, to your point, Derrik, the quality of the companies has gotten better. Initially in the early days, I saw a lot of the startups on the platforms where you really just saw one person there, the CEO, right?
Yes.
And the problem with that was that, like I remember one time I had an investment in a company and it was just this lady, right? And the valuation of the company was 4 million. So I put in my money, whatever it was, like 500 bucks. And then, 6 months later, she got a company came along and said, I'll give you 4 million for your company, as an acquisition, right? So now she was wealthy. Who cares about the shareholders, right? And what I got out of it is I got only to the exact dollar, actually a little less because I didn't get my fees back, but I got back the money I'd put in, right? So when in the earlier days, I saw a lot more of that where it was just, you saw one or two people in the company and they're going to take and run with the money because you don't have a whole team there where everybody's interested in making the company succeed and in them, getting their payout too.
Yeah.
So I am seeing now where there's a lot more, the companies typically have a whole team, and that was not so much the case 5 years ago.
Yeah,
so-
to your
yeah.
point about the teams and the factor, I've actually seen a lot of times where the founder dies. I know it's sad, but this is a stressful life being a CEO running a startup. And I have about 6 companies where the founder died. You're like, what? That's a center point of failure for all these things, for most of them. So having good teams is important. And I definitely advocate for that. I also, as I've gotten better, I've started looking through some of the documents, and there's some interesting pitfalls in there. That's a whole nother series. I could talk you through some of the things that I've seen that would go, what? How'd they pull that off? And like she said, they'll take an exit, makes them, you get tired, they get burnt out. They'll take an exit that allows for them to, hey, I've been working on this 10 years, get a little bit of profit, I'm out, because their valuation is different than yours probably when you came in. So, their exit is they came out with something. So,
because the platforms are growing, I think to your point, Andrew, that where platforms are saying, oh, we only take 1% of companies that apply to be on our platform. And so in the early days, I think that there was not a lot of due diligence that went into selecting the companies. As a matter of fact, I invested in one of those kinds of companies several years ago where it was one guy. And a couple years later, I actually contacted him and I said, hey, how's my investment going? What's going on? And I realized just how little there was to the accomplishments and to the history and what he had done. And I was kind of mystified that he got onto the platform when he really had very little actually going. But it ended up being good that I contacted him because we had a lot of discussion. I offered to help him and I offered him some help. And then he did another startup and he invited me to be a co-founder. And so today I'm actually co-founder of another startup, all through, as Derrik, you point out, the connections, right? You get out there, you meet people, you network, you contact the company. So the networking is not to be minimized. That does happen.
value add investing.
We only have 4 minutes left, and I just shared something so not everyone may know this, but we have this thing called the Crowdfunding Eco, where it's an amazing resource for those who haven't used it. There's just so much interesting stuff shared, and you can ask questions, and maybe someone from the CFPA can share the link to join that. But I saw this article. There's another scandal. I haven't even had a chance to read it yet. But thank you, Brian. So in the last 4 minutes, I'd love to hear a minute and a half from each of you or a minute from each of you on what you see as the future of the space. What's going to happen? Is it going to grow? Is it going to implode? So let's start with Niki.
Well,
Let's maybe keep it to under a minute each.
Okay.
Yeah, at this point, under a minute.
well, I think it's going to depend on what the reputation becomes, because as you pointed out, it's a pretty new industry, right? And I'm always looking at the statistics as far as what's, for early stage companies, what's the percentage that an investor can depend on. If you have 10 companies, are you going to end up making 10%, 100%, 1,000%, right? So I think it's hard for me to say, because I think we need more statistics that are going to be developed depending on the success of all these companies, the platforms, as you mentioned, lawsuits. If the reputation gets to be that this is very treacherous, then that's going to impact it.
Andrew.
I think that we're going to continue to see consolidation in the space as platforms. There's room for a lot of them, but only so many of them. And I think there will continue to be consolidation in the different sectors. And I also think that we will see, again, in that normalization front, I think we'll start to see more traditional financial services companies opening up ways for people to put little bits of money into these things, whether it's ETFs or other things, or robo-advisors, or however it's done. I think we'll start to see it become more mainstream, and I think that's an exciting development.
Derrik, you have the last word.
Oh, say it again.
You have the last word.
I'll keep it less verbose. I definitely think the industry is going to grow big time. I think the traditional banks and all the other players, financial players, are going to get in. I take a slightly divergent point, though. I do think that while the main platforms will consolidate and we're going to see a rush, once we have a couple successes, a rush for companies, I actually think that it'll diverge into ecosystems. And through these smaller ecosystems, they'll help keep the companies disciplined and help them grow and become more strategic advisors for some of these raises, I think. I'm hoping.
Awesome. Thank you so much. And I'm going to just do a shameless plug of something. Since you mentioned ecosystem, I'm working on a place-based ecosystem in Baltimore. I just shared the link on that. If you want, if you're interested in, we believe that there's a great opportunity to focus on place as a way to grow this ecosystem. And of course, everyone has their own theory at how to grow this ecosystem. And I'm glad we're all working on doing that. So any last words, Devin?
Thank you very much. That's the last word. We are so grateful, Jenny, to you and to all of the panelists who participated today. We're thrilled to have had you here. We're grateful for your insights. This was just a riveting discussion. And there's so much I think we learned from people who have been there and done that hundreds of times each. So thank you all for being here. We thank everyone who came to attend the event today. We're grateful for your time and attention. Again, I just shared the link to register for next month's webinar. So that will be on September 13th. So 5 weeks from today. Please join us. Again, that's free, but please register in advance so you don't forget. Get it on your calendar. Thanks, everybody, for being here. We'll see you next month.
Thank you.
Thank you.
Bye.